Hi guys. Hey, thanks for joining us today. Today we're going to be talking about understanding your homeowner's insurance, and this particular training is for lenders and even real estate agents. So why are we here? First, let's familiarize lenders with our homeowner's insurance and property insurance to help lenders become a more valuable asset. I can read these. You can read these too. We want to show how us as Inside Insurance can be a valuable partner to your lenders as well as to your clients. So, homeowners policy, let's jump into it. There's 6 basic parts to a standard homeowners policy. They go from coverages A through F, A, B, C, D, E, F, and they each have or provide coverage for different areas on here. We're going to run through these. So, the ultimate question is, right, how would your client rebuild if the worst of the worst happened? That's why we have insurance. It's to protect against accidents or unforeseen things. Nobody expects any type of damage to their home, but it happens, and that's why we're required to carry homeowners insurance. As a lending professional, as a real estate professional, you can help protect your clients and make sure they're getting put in a good spot so that if the worst of the worst ever happens, they're going to be taken care of. To do that, you need to understand a little bit about the policy. So we're going to run through each of the 6 different coverages, and then we'll jump into a few other things that you need to understand as well too. So coverage A is the dwelling. That's the primary coverage. That's the coverage that most people look at and are concerned about, and that's what your underwriter is going to require to meet certain guidelines, is the dwelling coverage. As a lender, you want to make sure, or the bank wants to make sure, that they're lending money on a property and it's going to be insured appropriately, and that's where the dwelling coverage comes in. Dwelling coverage is based on replacement cost estimator, not the market value. That's a huge thing to understand. When we work up a homeowner's insurance policy, we plug in the details of the home, like the age, the size, style, square footage, that type of thing, and it spits out a cost to replace the home if something were to happen to it. The coverage is subject to a deductible. The dwelling amount is used to calculate the other limits of the policy. That makes sense. So let's jump in real quick to the replacement cost versus the listing price or the market price, right? Replacement cost is the amount that it would take to rebuild the home if something were to happen to it. It burns to the ground. We're going to look at the price of labor, raw materials, demolition, debris removal, building permits. Basically, what is it going to take to rebuild the home? That's what the replacement value is. The listing price or the market value has nothing to do with what it takes to build the home, but it has to do with the supply and demand in the market, has to do with other homes are selling for in that area. And that can change based on market and economic factors, right? So or insurance coverage is not based on the market value. Also keep in mind let's go back. The market value does include the price of the land, which obviously isn't insurable because the land's not going to burn up in a fire, right? Okay, so let's move to coverage B, other structures. Coverage B is for detached structures. Typically starts at 10% of the coverage A. It is subject to the deductible. You can increase it if you need to, right? But detached structures or other structures are like your garden sheds, your detached garages, swimming pools, gazebos, detached patios, decks type thing. If it's not attached to the home, it's going to fall into this other structure section. Coverage C is your personal property. This is important for clients to understand. But basically, if you moved it, when you bought the home and you moved it in, this is what's going to be your personal property, right? I like to say that if you take the house, pick it upside down and shake it, everything that falls out is going to be your personal property. And it's going to be covered under this coverage C. Coverage typically starts at 50% of the dwelling coverage, but that can be increased. And there are certain limits on items like jewelry, fine arts, collections, antiques, firearms, those type of things. So just beware of that. All right, coverage D is your loss of use. This is very important coverage. Typically starts at 20% of the dwelling. It can be increased on some policies. There's no deductible for it. What it is it's the, hey, if you can't live in your house due to a covered loss, where are you going to live and who's going to pay for that? That falls under the loss of use coverage. The last 2 sections have to do with liability coverage. This protects other people for getting injured on your property. Coverage E is your liability. Coverage starts at $100,000. We typically write them at $300,000 or greater. Typically, we like to stick at the $500,000 mark just because, hey, in today's society, people like to sue, right? So your liability coverage is coverage for defense and settlement if you're sued or you're found negligent for injuring other people or their property. Dog bites, slip and falls, that type of stuff, right? Last coverage that we're going to go over is coverage F. That's your medical payments. This is similar to your liability coverage. However, this is just for small minor incidences. Typically, coverage starts at 5,000 or at 1,000. It can go up to 5,000. A couple of carriers will go higher than that. But medical payments protects people if they get injured on your property, small injuries, so that they can be taken care of and don't turn into large injuries. For example, if you're having a barbecue over at the house and you've got a bunch of neighbor kids running around, a kid kicks the ball up by the barbecue grill, runs up to grab it, and accidentally burns his hand. Right, needs to get taken to the clinic to get taken care of. It's a small, minor medical thing, and the homeowner's insurance is going to pay for it. Right, no deductible, no issues, no problems. Run out there, the insurance company is going to pay for that without any issues at all. So, great coverage to have. All right, so those are your 6 primary coverages: A, B, C, D, E, and F. That covers all of the property coverages. A couple of insurance terms that we need to go over real quick. The first one is replacement cost. We talked about that briefly, but it's the cost to actually replace the items or replace the dwelling or anything that was damaged or destroyed to its pre-loss condition, right? And below that is your actual cash value. Actual cash value means the current market value of that minus depreciation, meaning if you bought a couch 15 years ago, it's not worth the same that it was when it was brand new. So actual cash value gives you the depreciated amount. Okay, on the right-hand side, we've got open perils and named perils. These are 2 important things that a lot of people don't understand about a homeowner's insurance policy, is that the policies can be written with an open peril coverage, meaning it covers everything except that which is specifically excluded, or it can be written on a named peril, which means it specifically states what it's going to cause. Now, obviously, the open peril is much more broad. It's a better coverage. That's where we'd like to see people at. That provides the best homeowners coverage for you. But named peril is a great option as well, too. Okay, let's jump into the type of policies. Gosh, we're flying right through this. Thanks for sticking with us. Type of policies are written by the homeowners form, HO. And so we've got HO3, 4, 5, 6, and then we've got a DP1 and a DP3. DP stands for dwelling policy. And these are just the forms that the insurance forms or contracts that the policies are written on. Contains all of the language on how things are going to be insured and covered and whatnot. So here we are. We're going to run through a couple of these and how they might be different on here. The HO3 is the most common homeowners policy. It's an open peril policy on the dwelling, and it provides replacement cost on the dwelling, right? So that means unless it specifically says we're not going to cover this, like earthquake or flood, then it should be covered for the dwelling coverage. Now, your personal property, that's your coverage C. That's going to be covered different. That's on a named peril coverage, and replacement cost is available, but not always included. Sometimes it's going to be on that actual cash value right there. The HO5 policy is the most comprehensive homeowners policy. It's better than the HO3. It provides, again, the open perils and the replacement cost on the dwelling. But on your personal property, it provides open peril coverage instead of named peril. Replacement cost is included. And there's usually higher internal limits on things like jewelry, computers, fine arts, firearms, those type of things. So the HO5 policy, if you can get one of those, that's going to provide you the best, most inclusive coverage, most comprehensive coverage on there. You've probably heard the term HO4. Maybe not as a lender, but that's a renter's policy is all that means. So there's no dwelling coverage on there. It's just going to be coverage for your personal property and your liability coverage. And it's typically like an HO3. It's a named peril, and replacement cost is available. And we typically look to that. Now, here's one that you're going to hear a lot of, an HO6 policy. This is the form that condo policies are written on. So condo policies are a named peril policy. There are a few carriers that will write an open peril on there, but most of them are going to be named peril, both on the condo itself and on the personal property. Now, with the condo, there's always an HOA, or there should be an HOA master policy on there that covers the dwelling. So there are some coverages that we need to make sure are listed on some dwelling coverages are listed on the HO6, and we'll go over that in a bit. But this is kind of a hybrid between a traditional homeowner's policy and a renter's policy on here. A big coverage that a lot of people absolutely should have is called loss assessment coverage. That's available for your condo policy. And it covers losses that are assessed to each unit owner by the association. And there's typically coverage up to $50,000. We always recommend people start with at least 10 and go up from there. It really depends on how the HOA is funded and managed. You know that there's a wide variety in the types of HOAs that are out there. Some are managed very professionally and well taken care of. Others are not. And so you want to just make sure you've got the right coverage on there. HO6 is very important to insure. provides coverage for the home. Coverage for your home for damages under the HOA deductible. So most HOA deductibles are a $10,000 deductible. To any of that damage between the 0 and 10,000 that you're responsible for, you should have that covered on your HO6. It can help you meet the HOA deductible, which is very important. So if your HO6 policy, your personal homeowner's HO6 policy, condo policy, has a $1,000 deductible, let's say you start a fire in your kitchen, it burns your unit and a couple of other units, causes damage. You're responsible for the HOA master policy deductible. That's a $10,000 deductible. You're going to have to get out the checkbook and write that big fat check. Unless you have that coverage listed on your HO6 policy, then you just pay your deductible, your $1,000. The HO6 policy can pay the master policy deductible, and then you're not out $10,000. You're only going to write your $1,000 deductible check, and your insurance pays their insurance. Their insurance fixes everything. Understand how that works? Very important to get that right. Okay, we're going to blow through the last two. Dwelling fire policies. These are typically for vacant homes or builder's risks. And a DP3 is more of a landlord policy. So a non-owner occupied policy provides loss of use coverage for rental properties. It provides landlord liability. Typically, there's very little or no personal property coverage because the landlord or the owner of the property does not have their personal property there. It's all the tenants' stuff. So those are the last two policies we'll go over. A couple of things that are not going to be included on your traditional homeowners policy unless it's specifically endorsed or a separate policy is added is earthquake coverage. And then that's going to require a separate policy. And then flood coverage. What do we know about earthquake? That's not as important to you, but if you're going to, most lenders, I've never seen a lender require that. If a lender does require it, we can get into that. But typically I don't see that. Older homes, here's something important to look at. We're not going to insure homes that are that old, right? But maybe a little bit older home. In Salt Lake area, we see a lot of these older homes up in the avenues or like Salt Lake. Well, there's older homes everywhere, right? You know that. So let's jump into that. A couple of things that the insurance company is going to be very concerned about are upgrades to the mechanical systems. They want to know about the age of the electrical work, the plumbing, the HVAC, the heating, and particularly the roof. The roof's going to be a big issue. Water loss through the roof is the number one cause of loss in Utah. So we want to make sure that's taken care of. A lot of carriers won't write home policies if the plumbing hasn't been updated, if they've got the old galvanized piping, or if they've got knob and tube electrical. Insurance companies are going to have an issue with that. So if you have a client that's looking at an older home, it's a safety thing too, but you want to make sure that that's looked at appropriately for the right insurance. Flood insurance, some mortgages are going to require that depending on the flood zone of the property and where things are. Flood insurance can be provided by NFIP or NCIP. NFIP is the National Flood Insurance Program. That's the government organization. NCIP is the National Catastrophe Insurance Program, and that's private coverage. Most lenders right now are still accepting policies or are accepting policies now provided by each. And so everyone in the country is a flood zone. Is in a flood zone. Floodings can happen in areas that you never even thought of, especially here in Utah. As we're looking at that, if you're required to have flood insurance, make sure you're working with somebody that understands how to get you the best policy, the best coverage for your client, and obviously at a price, because depending on the flood zone, these things can be pretty spendy. All right, last couple of things. We've got 3 more slides to jump into. Price is very important, but it's not important at the sacrifice of proper coverage. So here's 6 tips that I'm going to run over to help you get the lowest possible escrow number for your borrowers. We're going to run through these. Number 1, work with an independent agency like Inside Insurance. We have multiple carriers that we can shop with. We do shop around with 20 plus carriers, so we can find the right fit that's most appropriate for your client. Again, keeping in mind that coverage is the most important thing for them, but price is also very important as well too. Number 2, accuracy on your quote is very crucial. We take time to make sure that your dwelling coverage, your coverage A, which is what your underwriter is going to require, meets or exceeds the requirements that you guys have, so that you're not going to have any issues getting through underwriting or any problems like that. And then obviously completing the evidence of insurance appropriately, timely, accurately, all that type of stuff is going to make you and your processor's life so much easier. Number 3, the extended replacement cost utilization. We use this on almost all policies, especially when you're getting in markets where 100% financing or low or no down payment requirements are being added. the extended replacement cost coverage typically has language like we've include increased building limit coverage up to 125% of the dwelling coverage, that type of thing. Okay, number 4, maintain a sensible deductible. Typically, we start at $1,000 deductible. We go up from there. Having a larger deductible can impact and will make a pretty big impact on your premium. Here in Utah, our homeowners policies are actually really, really cheap. We're one of the lowest in the nations. And so moving up from a $1,000 deductible to a $1,500 or $2,500 deductible can knock 20, 25% off of your policy. So those are options if you're having issues with debt ratios, or even a client that understands that, hey, they're sharing part of the risk by having a larger deductible. You can save money by having a lower premium on that. Number 5, get every discount possible. Whenever we talk to your clients, we want to make sure that we're maximizing those discounts. It's free money basically to your clients. So we're going to ask questions like education and employment, associations, that type of thing. We're seeing a lot of carriers coming out with smart home discounts. Obviously, alarm system, not just a fire alarm system or burglar alarm system, but we're seeing smart home gadgets and stuff like that that carriers are providing discounts for. So again, take advantage of every discount. Lastly, we want you to prepare the bar to communicate with the agent directly so that they don't assume that you're the agent or the point of contact for any future requests or issues. And again, so that we can go over the coverages that are most appropriate for them and make sure that they're insured properly. So we're just going to finish it up right here. You can count on us at Inside Insurance to take great care of your borrowers. If you have any clients, you want to call us directly, you've got our contact information. You've worked with us before. You know that we're going to do a great job taking care of them. So, hey, thanks so much for sticking with me through this presentation. Hope that helps you understand a little bit more about the homeowners policy, and again, about how we can help you take better care of your clients and make sure that they're getting the coverage that they need at the best price possible. Hey, thanks so much. We'll talk to you later.